Okay, good afternoon everyone. Welcome back to Track B, the Direct Lending in Focus track. This is the lower and middle market going above and beyond session, moderated by Susie Newworth, founder and editor-in-chief at Alternative Credit Investor.
Okay. Hello everyone, welcome to our panel. As you've just heard, my name is Susie. I run Alternative Credit Investor magazine. If you haven't picked up your copy already, please do from our stand downstairs. I'd like my panellists to introduce themselves briefly, starting with Ravi on my left.
Thanks, Susie. Ravi Anand, MD of ThinCats. We're a lower mid-market or mid-market SME lender. I've lent about £2 billion. We lend only in the UK to about 300 companies across the UK. And we're a balance sheet, so we lend off our own balance sheet. We're a non-bank lender rather than a fund, which I guess is somewhat relevant, but not completely. So that's us.
Hi, good afternoon all. Greg Betts from Investec. I co-head UK origination within the direct lending team. So the direct lending business at Investec was set up in 2010, investment team of 50 people. We are active across the UK and Ireland, Benelux and DACH regions, principally focused on the lower mid-market. Across our track record back to 2010, we've deployed around 10 billion of assets across circa 350 investments and currently deploying about 1 billion per annum.
Derek Green, Investment Director at Cartesia. Cartesia is a pan-European private debt platform, currently managing 7 billion euros AUM across a range of credit strategies, all with a focus on the lower mid-market. We typically look to invest between 20 to 150 million, both in sponsorless and also sponsor-backed transactions. Currently have a team of over 100 professionals with offices located in London, Brussels, Luxembourg, Milan, Munich and Madrid, and also Amsterdam.
Gareth Casement, Head of Loan Services at TMF. TMF provide outsource solutions for loan services, loan accounting, record keeping and agency across the globe.
I am José Ignacio from Tres Mares, which is a private capital platform with its origins in Spain. Today we are managing 3.5 billion of assets under management. We have offices in Spain and Madrid, in Madrid and London, opening a new one in Munich this year, although we can lend to most of the Western European countries. Focus on debt, sponsor-backed and sponsorless transactions. We focus on what we call the lower mid-market, so tickets below 75 million euros. And we have an investment thesis more focused on growth.
Thank you, everyone. So I'd like to first ask about, what do you think current conditions are like in the lower and middle market? Ravi, if you'd like to start this one.
Yeah, it's a quite a volatile market, and what I mean by that is that it's hard to predict, and I think some of that is stemmed from all the different crises we've been through, but particularly what this government has created in terms of the growth around the economy and all the noise they've created, notwithstanding. Even today, I was in my office listening to the statement, not an awful lot of positivity came out of that in my mind. So that, I think, has created uncertainty in a lot of borrowers' minds. And what happened the last 4 months has been quite subdued, but we do see that coming back. And I think people are just getting on with life, by and large. I think rates, whether they go down or not, they're stabilised, and I think that's sort of helping people make those sort of investment decisions and understanding what cap stacks look like.
Is that what other panelists agree with? Dara, is that in line with your view?
Yeah, I think you need to probably split between obviously the sponsor-back segment and also the sponsorless. I think on the sponsor-back segment, you've definitely probably had a slower start to the year, albeit flow has definitely picked up probably since mid-February. I still think there's probably a mismatch and demand-supply imbalance in that market though, and I say that in the context of too much dry powder, waiting in the wings, both on the credit and the equity side, and a lack of really high-quality assets coming to market. So what we're observing in that market is intense competition between lenders for high-quality assets. I think on the sponsorless segment and within that particular area of the market, I think flow has been good. It's been positive, albeit the nature of those deals, they naturally will take longer to transact. Just given the profile, the characteristics, you're typically working directly with the businesses, and at times you are the first institutional capital that these businesses will actually take on. So that is a challenge that you're always faced with in that particular segment. But on the whole, I think in the sponsorless world, we're benefiting from probably business owners becoming more aware, more open-minded to using private credit for a range of strategic and financial initiatives.
If you could have our first audience poll up, speaking of sponsor-backed and sponsorless, be good to see what does our audience prefer. So far, loving sponsor-backed.
That's classic.
It'd be good to hear, the other panelists' views on sponsor versus sponsorless. Jose, do you have a preference?
Yeah. Well, obviously, the direct lending product, it fits very well with the sponsor-backed transactions, especially on buy and builds projects where we have usually more flexibility to start with a lower ticket and continue deploying capital, helping the sponsor to buy new transactions. However, I would say as a debt provider, Tres Mares is happy to also work for sponsorless deals, where obviously you see different dynamics. As my colleague was saying, usually timings are slower, conditions are slightly less aggressive in terms of leverage, because you don't have a sponsor behind that can cover the gap in case something happens, and you need to rely more on the quality of the asset. But I would say both worlds are very interesting with different dynamics. It's true that the vast volume of transactions are coming from the sponsor-backed deals.
I'd maybe just add to that, and for context, I suppose at Investec we're probably 80-20 sponsorless, but do think any good private credit portfolio should have a mix of both of those deal profiles. I think, as others have said, the transaction time scales can be a lot longer. There's an education piece, and in some cases the information availability may be not as well ribbon tied as you might get in a sort of formal sponsor process transaction. But I think the sort of economic potential of some of those sponsorless deals it makes that additional effort well worth it. So a good segment for sure.
And I think there's probably a misconception in the market that sponsorless deals are more risky than sponsor-backed. As Jose was saying, typically in sponsorless transactions, they're actually more lender-friendly. And I say that in the context of lower leverage structures, more moderate LTVs, stronger documentation, protection and controls. And probably the other point I would just make is typically in these deals, we often observe actually stronger alignment with the management, the shareholders and the business owners that we're actually backing compared to a sponsor-backed deal. And I say that with an example of imagine a multi-generational family-owned business that you partner with. If there are any bumps or, let's say, growing pains along the way, rest assured that those people that you are dealing with will do everything in their power to steady the ship, to keep their baby alive, you could say. And I'll probably summarize it probably in one statement, this alignment piece, that skin in the game and alignment in sponsorless deals goes far deeper than day one capital at risk.
Very interesting point. I mean, it looks like our audience is quite split, so perhaps there is an argument for both. So whether sponsor-backed or sponsorless, are there any particular sweet spots you're seeing in the market? Jose, is there anything in particular which is interesting you at the moment?
What I feel, and maybe my colleagues agree, is that usually we see like waves of sectors. So, for example, this year we have seen a lot of deals in the fire and safety and health and safety and fire tech companies. We have seen like maybe 7 companies in a row. Last year we received a lot in the IT consultancy businesses. So I would say usually the sponsors are looking always for asset-light businesses with high cash generation, revenue recurrency. So everyone is looking for the ideal deal, but in those is where competition is being extremely high. So this is where we are seeing the competition and conditions going down. Sorry, competition going high and conditions going down. But yeah, I would say from the lender perspective, usually we are sector agnostics.
Ravi, do you?
Yeah, no, I think that's right. It all seems to be focused on business services or recurring revenue type businesses. I think tech continues to be a very strong theme because a lot of those businesses are coming out of perhaps growth and now profitable and can perhaps potentially lever. So it is the nature of the revenue streams rather than necessarily sectors. You just don't see a lot in consumer or construction or these very low margin businesses. And I think margin's the other point. Everyone's after something with, teens, 20% EBITDA margins, because if there's a hiccup, you can withstand it.
Makes sense. In terms, obviously, this is a competitive segment of the market. Are you seeing a lot more competition from banks these days?
Happy to take that one. Obviously, we're a credit manager within a bank, so we sort of wear both hats. And I suppose the way we approach the market is generally trying to structure with a flexibility more akin to how sort of funds tend to navigate the market. I think in terms of bank competitiveness and activity, it depends a little bit which end of the size spectrum you're talking about. So if you take, I suppose if you go into the upper mid-market space, broadly syndicated loan market has had a bit of a resurgence of late, and I think banks can probably take back a bit of lost share there, just as that market's reopened and been quite compelling avenue for borrowers to access. I think if you contrast that with the sort of 10 to 60 million EBITDA range, I think that space has become a lot harder for banks, and I think some of that is reflective of challenges around solving for the size of debt packs that are required. So if you dial back maybe 10, 15 years, you could pull 200 or 300 million pound or euro debt stacks together with a club of people doing 20 to 30 million commitments. That nature of deal has completely gone away, and private credit has taken that middle ground, should we say, very compellingly. So banks in that space are tending to play either in sort of super senior RCFs alongside a unitranche or maybe first out super senior pieces. Not really where we try to play, but that's really the sort of most accessible parts of the capital structure for that size segment. I think in the sub 10 million EBITDA space, where with most banks able to hold maybe 30 to 35 million on balance sheet in the absence of any internal funds, platforms or partnerships, I think that smaller segment, they're a bit more able to navigate that size dynamic and be a little bit more relevant. If I take the geographies we're active in, being UK and Ireland, Benelux and the DACH region, it is though probably only 1 to 2 bank lenders who are really sort of front-footed and super active in market. So that I think while the bank's a bit more active there, it's still relatively less competed versus some other size segments.
On that lower end, actually, because that's where we operate, we don't see the banks at that lower end. Definitely not the clearers anyway, because they've sort of lost the skill to work with those smaller borrowers and just the cost to serve. We do see some challenger banks. The likes of Shawbrook are very competitive in that lower end of the market where we operate, but it's not that well served at all. Even though the holds, as you say, the banks, some of the banks won't hold even 20 million, which sounds a bit counterintuitive, doesn't it? You bank and you won't lend more than 20 million, and they have to partner with whether it's a credit fund or the asset management arm or whatever else. So there are constraints within the banks, both personnel and risk weighting and skill sets, I think, to do this.
On the other hand, I would say the debt capacity of the businesses with the SONIA environment or the base rates that have been very high in the last couple of years has reduced the gap in the total leverage capacity offered by banks and the offered by the debt funds. I think that this should end soon with the base rates going down again. But this is something that we have seen in the market, especially for tickets where banks were still competitive. Previously, maybe, I will invent the numbers, but maybe 3 years ago the bank was offering 3.5 and the debt fund was offering 5 times. At some moment in 23 and 24, banks were offering more or less the same, 3.25 or 3 times, while funds have reduced a little bit the leverage to 4. So maybe in that moment of time they were more competitive and they have gained a lot of deals.
And I think just a final point on this, I suppose, this query and obviously the competitive dynamics against banks and funds. I think it's important to note that bank lending and private credit is not always mutually exclusive, you could say. So what we are seeing and what we actually very much welcome in some of our deals is collaboration with banking partners. And I think that's probably a trend that you're going to see long term in the market, is banks proactively working with private credit funds in a win-win situation.
I think, Susie, that as an outsourced provider, I think that's certainly what we've seen. Obviously, we're one step removed from what my fellow panelists are saying, but from our perspective, if I look at kind of the history of what outsourcing has been, it's quite a mature market in terms of broadly syndicated, the tools and technologies there. Some of the workflows have been adapted. What we have seen probably in recent few years is the technology changing due to this change in the dynamics. So, for example, the ability to provide higher quality covenants either from stuff that's within a loan accounting platform or bringing stuff in as of from outside. The ability to kind of to look at the deals up front and do all the modelling and the deals as opposed to work with an agent. And as part of that, with a lot of these structures, either collaborating with investment managers to perform part of things that maybe an agent would have done, in a lower, in a BSL, in a lower mid-market scenario, such as, like borrower notices provision, or smaller club deals, agency functions, etc., etc. So I think from our perspective, that's where we're seeing really all the conversation happening in a minute in terms of what's out there,
Thanks, interesting perspective. So is everyone expecting to see more partnerships between banks and alternative lenders? Greg, what do you think from your position at Investec?
Yeah, there's been quite a lot of activity on that front. I suppose our perspective on it is we've attacked that, question a slightly different way by building fund platform, within our business, and plan to try and scale that significantly over the next few years. I think taking a UK focus, it feels like almost every bank, if not every bank, has either got a partnership on somewhere on the spectrum of formal to informal, always exploring that. And I think we would expect those collaborations, to Darryl's point, to continue and to increase. I think the rationale from both perspectives, bank and fund, is very strong. If you think about funds, it's about access to the origination capabilities of banks. A lot of banks within their broader setup will, just giving you a sort of example on our side, we've got an M&A team with north of 100 bankers out putting deals together across Europe. We get some opportunities from there. We've got a treasury desk who will deal with 1,000 corporates in the UK where there's doors to knock on. Fund finance similarly. So banks have quite broad sourcing capabilities from relationships which private debt lenders can tap into. And then from the bank perspective, it opens up a universe of deals that wouldn't be otherwise in scope for a lender because of some of those hold capacity constraints. So lenders able to solve for the capital requirements of their borrowers, collaborating with deep pockets alongside them.
And I would add as well, sometimes banks are in a position where they have a portfolio company that is growing much more than they can offer. So instead of losing that transaction, they are inviting a fund to co-invest with them in a full structure, in a pari passu, in a senior plus mets, whatever the structure is. But it's a win-win situation, right? Because the bank still has the portfolio asset in their book. It's a quick win. For the fund, it's something that is a good opportunity, a different origination channel that also can be explored as a program. So you don't stop in only one transaction. So something that we are seeing, and I think I do agree. I'm pretty sure we will see it more in the future.
Okay, so banks are essentially eating or trying to share your lunch. What about the largest alternative asset managers? Do you think they're also tapping into the lower mid-market space now? Don't know who wants to take this one first.
I think actually the way they're tapping into it is through people like us, who they will partner and provide a forward flow or some other sort of relationship and managed account if you want, because the sourcing and credit requirements at this end of the market generally don't exist in those organisations. So I think it's actually the other way. There is plenty of capital, absolutely, but they want to partner with the right sort of origination source.
I think as well on that dynamic, we're definitely seeing the larger funds drop down into the lower mid-market in terms of where we play. But I think that's reflective of a soft M&A environment in the pure mid-market and the large cap space. And obviously these funds are having to, you could say, fish in different ponds and source deals. I would caveat though that they are only interested really in buy and build or platform plays in the lower mid-market. That's the only situations that they will show appetite for, given the scale-up potential of those particular deals.
Yeah, I do agree. We are seeing the guys coming down. However, as we always say, as soon as the M&A market recovers in their part of the market, they will turn back to the lower end of the market. So we are always telling clients, be careful with who you marry with.
And I think, again, those players in that upper end of the market, and particularly in the funds, there's a certain set of parameters that they have to work under as well, pricing of assets, et cetera, et cetera. So there's a lot happening around service requirements when they do drop in as well. So I think that makes it an extra interesting time in terms of how the mix is happening in the marketplace, and also, you look at kind of mid-market CLOs and then some of the new stuff coming in, such as the LTIF and different things like that, where potentially more and more funds are trying to position themselves to look at these type of assets. So I think it is an interesting time in terms of how the market's evolving,
So with all this activity in the market and so much competition, how do you compete for deals? What's your secret sauce?
Shall I go first? I think we're all going to say the same thing. I think there's a few things, right? I mean, you've got to be in the market and consistently in the market. Taking Jose's point, this is a relationship-driven market. Sponsors want to know how you act, not just at the beginning, how you act through the life of a deal and working with them. And equally, non-sponsor borrowers also will reference you and want to understand through advisors and others how you'll act. So I think the relationship does count for a lot in terms of winning a deal, as well as obviously structure. But also the way we try and do is also have a broad range of products. So yeah, we're a senior lender. We're also a stretch senior lender. We also have a sort of working capital facility alongside that. And we'll think about asset-based if required. So, we're trying to, within a credit box, think of what's the right solution for that borrower, and being as holistic as possible, given at the end of the day we are overall senior.
I would say having a multi-product strategy is key. So the client doesn't have the feeling that you are pushing for only one solution. If you are offering senior, stretch senior, subordinated, preferred equity, if you can offer a fund financing solution, so you establish the relationship from a different angle. If you can be an LP of that specific fund with a different team. So if the fund is being perceived as a partner, you have better chances to win the deal. But as you mentioned, obviously, you are competing in a highly intermediated market, especially in the UK, where price and leverage is one of the key drivers to take the decision for clients. But I would say, stay consistent in the strategy. People need to understand what you are going to do, not only on the bidding, but as he mentioned, when things are not going so well, how you are behaving. And that reputation is key from my point of view, so people can trust you. Be nice to people is something that clients should value.
And I think just focusing once again kind of in the sponsorless deal segment, because that's really the heritage of Cartesia. I think it's about being able to bring value add to these situations. So whether that be helping management to improve governance, maybe helping them to improve financial reporting, maybe assisting with M&A, buy and build where possible. Really just helping businesses become probably more exit ready before a future more valuable liquidity event. I think that's what we feel is, I suppose, a differentiator definitely in the sponsorless segment. I think the other point to note is probably hold capacity can be a differentiator as well, particularly when you are looking to back and support and partner with buy and build platforms. So if business owners, management teams really want to go on, let's say, a 3, 4, 5, 6 year plus journey, if they can partner with one provider who has that scale-up capacity, that can be a differentiator.
And just linking into that, I think it's sort of been referenced already, but I think what's really important in this market is just borrowers / private equity GPs having confidence in deliverability, and that comes from tenure of team, track record in market, just good track record of delivering on what you said you would previously. I think is a very big piece of where mandates go.
Thank you. What about data and transparency? Do you think there's enough data available in the markets to support your jobs, essentially? And perhaps, Gareth, we could get your perspective first as the service provider.
I think for doing this for a while, what I would say is there's been a lot of variability, and it's kind of starting to normalise a little bit more. So I would say what I've seen historically, there's been a little bit of variability, which is starting to normalise a little bit more. So, like, certainly when I'm talking to somebody who's in the mid-market or lower mid-market, and we're looking to engage, just provide them with support, you know, I'll be wanting to see if they're operating kind of within documentation norms and that type of stuff, because that can help us kind of grow, you know, in terms of how we normalise things into the future, you know. So very often a lot of folks will try and stick to kind of boilerplate LMA templates, LSTA templates, whatever. What I think we're seeing is that allows us to, you know, kind of put the deals properly on the system, kind of make sure that we're tracking everything correctly. So I think that's an important anchor element. There is improvement around things like pricing. I mean, to an earlier point, I think some of these type of investments are more and more coming into investment products that require some type of mark to model. It's certainly in the minority, but there's a little bit of that. So there's improved transparency around things like pricing and potential ratings, verification rules on stuff that's observable and not observable. So I think there is improvement, and I think technology will improve that a little bit more. But it certainly has a way to go from my perspective to kind of normalise, you know.
What are the lenders saying? Would like to see.
I think when you are doing a transaction, the information available for this company usually is pretty good, especially on sponsor-backed deals. I would say there are like standard DD packages that should be enough to take a decision. I would like to have more visibility on where the market is on live. You need to, for example, as a lender, you need to understand what the market is doing in terms of debt capacity, who are the players you are competing with, what are the deals that are being closed, what are the economic conditions, and this is something that for the time being in the mid-market and from my point of view, will continue to be pretty dark or pretty opaque. And that's why also you need to be consistently in the market, talking to people, to all the different agents, to try to understand what others are doing, so you are not the outlier or with a big difference. So yeah, we'll love to have more information, obviously. Yes,
I definitely agree with the point around I suppose transaction data. Due diligence packs, particularly for sponsor deals, are very comprehensive, and I think all of the lenders on the panel will be in a similar boat in the sense of reviewing hundreds of transactions every year, and people have been in the market for a very long time. So you build up a huge database of performance data points on businesses and sectors, and that does help with reviewing new opportunities and working out pretty quickly where a business fits in terms of just key KPIs, etc. So I think the challenge for us is probably less about certainly when it comes to, I suppose, transaction and performance and market evolution data, it's not so much gathering it, it's actually how to condense and assimilate that into actionable insights is probably the bigger challenge, I'd say, just given volume.
Ravi, thank you. Ravi, you seeing similar sort of pressure points in your...
Yeah, look, I think I agree with a lot we've been said. I think in the end it's about as granular information on the borrower that you can get, and you get it quite late in the process. So yeah, we get decent IMs from sponsors, but you could put your term sheet out in the back of that. But actually what you want, and you know, our end of the market in particular, and particularly non-sponsor backed deals, if you can get an API into the accounting system and open banking, there's an awful lot you can do, right? And we've got open banking on most of our book, not new borrowers, but drawn borrowers. And that is providing a lot of insight. So that granular information about what's going on with the borrower, can I see what's happening with his top 10 customers, has he paid HMRC, all these sort of very basic things that can be red flags. And then trying to reinterpret that data around when you do see a borrower in the same sector or a similar type of sector, how you can look at his margins and his turnover growth versus the one that's on your book. In order to do that, you just need a lot of data, and you know, with a book of sub 200 borrowers, there's not enough there. So what we need is really a market solution around essentially what the government talks about but does nothing about, around open finance. And if you get an open finance where, you know, HMRC tax reports are available to the likes of ourselves, and you know that actually it's not a bad thing to open your accounting system early doors in the process, because you're going to get a better result. That I think is coming, but it needs a slight behavioural change and a policy change, regulation perhaps. So that then we'll get all the big data, the micro data that can become big data.
Have you done any lobbying on those kind of issues?
You know, UK Finance, who represent the banks, do a little bit, but not a lot. I think there's a consultation out right now around access to finance. It came out last week from Treasury, and that is within that as well. So yes, but it needs someone bigger than us to make that change.
That solution would be great. We in Interest Matters we try to lobby for the Spanish for this Spanish solution as well, but the results, I'm afraid, are being the same. But if you are able to cross web scraping with financial data from Companies House with some tax information, you can generate good reports on a macro basis where you can decide where to allocate the capital. This is something that, for example, we are doing in Interest Matters, but you need that information. For example, the Companies House in the UK is not including so much information for companies below 15 million revenue. Above 15 million revenue, I would say it's okay. Below that, the annual reports are kind of nothing.
So what about AI? Are you seeing many opportunities there, this part of the market?
Well, without data, you can't do AI, right? So, you know, a lot of people say, oh, AI, but yeah, you've got to get data, and you need huge amounts of data to make the AI work, right? So there are, you know, on the financial side, that's the case. I think there are things out there that somebody will read an IM for you and prepare part of a credit paper, and we're looking at stuff like that. Is that AI? Well, sort of. I think it's quite simple AI, because it's just a intelligent interpretation of unstructured data. So I think that there are some things being developed. They're all quite early, but I think it's about, you know, if even in that case where you're reading into an IM, half the time it will be wrong, so you still got to read the IM and make sure the thing's coming out properly. But once you've done it probably 100, 200, 300 times, it should self-learn. So it's getting to that scale that will help AI. I don't think it can be overplayed at the moment.
I think I agree with that. I do think that, and I have been at a conference before where folks talking about AI and overselling what it can do, but I think the movement, before we were having this discussion, we always talked about OCR, so the ability to, you know, put a document in front of an optical reader and tell it to look, you know, 2 rows down and 3 across or whatever it is. And if it can do that, you know, 100,000 times, it should get it right 50% of the time, you know. I think when you put AI into that type of permutation, rather than kind of instructing it kind of navigationally, you're instructing it by telling it what you need to get. I think that potentially is a real game changer in this particular side of the market. some stuff that we are doing in terms of how we can look at it in that way, you know, rather than kind of go and fetch it in wherever. And again, it comes to kind of consistency of reporting and data as well. If the data is not there, it's not there, right? But I do think that AI has potential when used in the right way to unlock more if it's out there, you know.
If we could have our next audience poll up, please. There we go. There we go. Do you see the lower mid-market again getting tighter or wider over the next 12 months? So please put your votes in. So it'd be good to hear from all our panellists, you know, about your outlook for the market, not just on pricing, but also pricing. And if anyone wants to kick that one off.
Yeah, I'll kick it off, although I don't have a crystal ball, unfortunately. Probably think that M&A volume will slowly pick up. I think that will probably be a function of increased pressure from LPs with their private equity sponsors to realise and exit legacy assets. I think that will drive flow and greater M&A activity. I think you'll probably see also a greater level of refinancing opportunities in the context of 2019 deals maturing, and obviously borrowers looking to reset their capital stack in light of expectations of further reductions in interest rates. And of course, the point I made earlier, just in terms of greater collaboration between banks and private credit funds. I think that's here to stay.
Yeah, share some of Dara's cautious optimism around M&A volumes. I think for those who attended some of the panels this morning, there was, I suppose, discussion around how much dry powder is out there, both private equity and private debt, and then also just the sheer volume of portfolio companies that were acquired in the run-up to COVID that have not come out of those private equity GP portfolios as yet. So quite big backlog of transactions will need to happen. So all things being equal, there should be ingredients for more active M&A market. It doesn't feel like that's going to happen in the next couple of months. It's probably more the sort of H2/Q4 type pickup in our minds. So I think cautiously optimistic on volumes, and that should then help to just ease some of the competitive pressures which have been referenced, and that pricing sort of extends there.
Yeah, no, I agree with that. I think on pricing, given we never really moved pricing much or margins much when rates went up. They pretty much stayed static. So, you know, we're sort of 7 to 8s over. And I don't see that coming in. In fact, there's an argument margin could go a little bit wider as rates come down, but I don't think that'll happen. But in the end, I think it's quite price inelastic, actually, at our end of the market. It's about structure and relationship that drives people will pay a bit more for that.
I would say optimistic, but not in the very short term. I would agree with my colleague. We have been told in the last couple of years that the next second half of the year is going to be better, and this is something I have been hearing since I joined the UK office in 23. But it still is not happening, that boom. That should happen, because what is clear is that some sponsors are holding their assets longer than expected, and those are good assets that have to come back to the market, right? So hopefully this is the year, but let's see.
Gareth, do you have any predictions?
Pass. On this one, yeah.
We've still got a bit of time left. Do we have any questions from the audience? Anyone? Everyone's feeling a bit shy or tired after lunch. So we've got a few minutes left. Been interested to hear from any of our panellists about what would be on your wish list for the next 12 months, if not outlook. I know, Ravi, you've obviously talked about open finance and how it would be great to have some more efforts from the government there. Is there anything else that any of our panellists would like to see? Which
growth. We need growth.
Yeah.
We just need a government that will get behind growth properly, rather than just the bullshit of words, and just get on with doing stuff that is really going to help entrepreneurs make investments, take risks. We're just walking through treacle, right? And I think we just need the noise to go. with that, of course, we need a better economic environment. We need the orange man in the States to shut up and get on with life. These things, there's not much we can do about it. But I think a bit more stability, and I'm sort of cautiously optimistic about this government getting on with it. But I think they're stuck a bit in their own mentality around got to balance the books rather than actually investing for growth.
Yeah, I think there's clearly some macro risks out there still, geopolitical and things like tariffs, and I think that depending on how things go there, that could act to unwind some of the progress on inflation. So I think wish from my side would be just steady sort of downward trend on base rates, and inflation remaining sort of at target levels and on the way down. I think should just give collective confidence to buyers and sellers of companies and lenders to companies to get the sort of deal machine really moving.
Anything else on your wish list?
I would say stability in all the inputs. So, for example, what we do not like when you are investing capital for 7 years is facing the risk of a binary change that can heavily impact one of your businesses. So, for example, I don't know, if you are thinking on NHS, if there is a change in the NHS policy of subcontracting providers, that can have an impact. So, linking to your point, I mean, geopolitical risks, reduce those to the minimum. Regulatory risks within each of the countries to the minimum. With this, I think we can work well.
Yeah, again, to what I said earlier, and that I'm one step removed from my fellow panelists in terms of the process of originating in this space. But from my perspective, I think some of the things out there in the fund regulation has the potential to create more interest in this type of asset class. Certainly from our vantage point as well, we're seeing more and more inquiries. Kind of before we had a set of products in certain boxes depending on what certain managers need, but I think what we're seeing in this space is that there's a little bit more kind of selective, so for example, agency in certain deals because of the way something has been structured or whatever. So we're seeing it a little bit more kind of uncertain in terms of what we see the products at, which I think is a good thing. So I would say that I could imagine more entrance and more opportunity in the space.
Probably just a final point from my side, particularly for the lower mid-market, would hope that lenders remain disciplined and selective on terms and not drag the market down. Obviously, as I said before, there's intense competition for the right assets, but I think if we, as market participants, can, as I said, remain selective, disciplined, that would be important going forward and would be helpful.
Great. On that note, well, thanks so much to all our panellists. I think we'll wrap this up now if there's no questions from the audience. So thanks so much to all of you for a great conversation.
Thank you very much to Susie and our entire panel. It was a very fascinating discussion. We're going to move straight on into our next session. We'll just get our panelists situated, which is breaking ground in the European middle market CLO.